Okay, good morning, everyone. Welcome to the investment meeting. Before we get started again, if we could just slow down on the introductions so that Linda can get the names. We're usually used to Annette, who knows everybody already, so just please a little bit slower. With that, I'm going to turn it over to the Commissioner.
Good morning, everybody. Andy Schaefer, representing Commissioner Kelly.
Barry Dennis, SAS.
Andrew, PBA.
Joe Alejandro, PBA.
John Giangrasso, PBA.
Chris McGrath, PBA.
Bob Ganley, SBA.
Tom Sullivan, LBA.
Demetrius Rumiliotis, CEA.
Spell that, all right?
It is a tough day.
Yeah, another good one for you. Paul DiGiacomo, DEA.
North, Actuary.
Yvonne Nelson, Controller's Office.
Barry Miller, Controller's Office.
Mark Yes, Controller's Office.
Mark Gross, Controller's Office.
Seema Ingarani, Controller's Office.
Thad McTee, Controller's Office.
Larry Schloss, Controller's Office. Rob Goldrich, Mayor's Office.
Ranji Nagaswamy, Mayor's Office, and I have the proxy this morning for Janet Amberine from the Department of Finance. Inga Van Nuys, Law Department.
Kevin Holland, Police Pension Fund.
Bob Sens, I'm going very slow. My name. You think from Lotus is bad? Pension.
Christine Fitzsimmons, Pension Fund. Kathy Martino, Controller's Office.
Okay, good morning, everyone. Welcome to the public session. With that, Larry.
Okay, we have the quarterly report to go through today, as well as the April results. So what I'd like to do is start with the economic and market slides in the monthly numbers. Then we'll go back to the March quarter. Then we'll go to the April numbers again. So, does anyone need a color copy?
I do.
Oh, sorry.
Larry?
Here you go.
Oh.
Coming.
I thought you were giving it to me.
Just get it through there.
Barry?
Close them over here, man. The highest somebody to bring them back.
Everybody got? Okay. I'll try to go through pretty quickly. As we've all been reading the paper, you can see on page 2, the economy is slowing down again. Not good for the stock market, the bond market, any market. And you can see it in this picture. People have been talking about 3.5% before, earlier in the year. Now they're talking 3. Looks like it's pointing below 3 to me. We'll find out. Page 3, capacity utilization has leveled off. Manufacturing index is coming down. Again, you're going to hear the same comments on most of the stuff. Weekly unemployment claims have moved up a little bit, but more troubling on the next page, page 6. The unemployment rate, if you actually extend it, is now 9.1%. So something's got to give. Consumer sentiment bouncing around. Generally not very happy. This is a problem on page 8. This is architectural billings. Remember, this is what goes before construction. So if they tell the architect to stop work, there's no construction coming a year from now. So this is a leading indicator, not a good sign, especially below 50. Existing home sales on 9 have leveled off. The big problem is on 10, which is new home construction. No new home construction, no jobs. No jobs is reflected again in the unemployment rate, and you need this sector to pick up. Retail sales have grown about 4%. Good. Auto sales, on the other hand, have leveled off. Not good. And then on page 13, you can see the leading economic indicators are starting to fall down a little bit. Inflation's on the way up. The Fed's not that worried about it. 3% would be nice. My guess it comes down a little bit in the near term. How did that affect the markets? If you go to page 16, the dollar has gone down against the euro. And if you look on page 17, again, off the floor, but not in a very good place, the U.S. dollar. LIBOR is flat, which is good. That means there's not a lot of anxiety, at least when it comes to interbank lending. The VIX is pretty calm. That's the equity markets. What's very troubling to me is the next page, page 20. The white line is the current Treasury yield curve. it's coming down, so rates continue to come down, which is good. On the one hand, on the other hand, it really penalizes savers. If you look on the next page, page 21, this is the 10-year Treasury rate. It's down. It was below 3% last week. It's at about 3% now. It was 3.5 plus in February. So this is just not good. It's really it's the safest place to put your money. So I view this as sort of the bond equivalent of the VIX fear index. There's a lot of fear. People are looking for a place to put their money. They put it in treasuries. The next page is high yield spreads, and the investment grade spreads continue to narrow and flatten out. We continue to lighten up our high yield position on the theory that yields are about as low as they're going to go. The next page are corporate earnings. Earnings are growing. The stock market's not going very far. I'll get that in a second. So the PE on a projected basis is about 15, not very high. You can see the next page, page 24, the Russell 3000, EFA, and emerging markets. The yellow box is the one that I look at, which is the projected. Actually, it bounces around. I'm sorry about the colors being in different places. It's the lower box that I look at, which is projected earnings, none of which is historically very high. So basically, stock markets are reasonably inexpensive. If you look in the U.S. markets, the bottom one is small cap. Small cap is getting expensive, and you see some of these internet IPOs that smell a little bit like a bubble again. Have to watch that. The biggest problem is on page 26. What you're going to see, it's not in these numbers we're going to talk about in March or April. It's going to be in the June numbers, in the May numbers. But you see the stock markets across the globe are down about 5% in the month of May, moving into June. So we'll have to, future reports are going to show that. On page 27, M&A volume is picking up. That's good. The best news is on page 28. The police pension fund crossed $25 billion.
A new high.
A new high. And you're up almost 27% for the year, which is awesome. We've given some back this month, so you're probably up in the low 20s right about now, but we're trying to close out the fiscal year if the market would stabilize a little bit. And then if you look up page 29, again, for the year, it's basically done nothing but go up. So let's stop right there. And then let's go to the quarterly report, which looks like this, right? And Martin will walk us through the quarterly report pretty quickly because, again, we have the April numbers. This is the quarter ended March, so we're going to go back before we go forward, but this is the only snapshot of the quarter as a quarter.
You have some extra copies here? With the March quarter did see increased volatility across the markets as unrest in the Middle East and the earthquake in Japan created uncertainties in the market. But by the end of the quarter, the market generally saw very strong gains. The Russell 3000 was up over 6%. Non-U.S. equities were up quite strong. And in fixed income, the investment grade 4+5 was up about 0.5%. Treasuries were down because at that time, rates, the 10-year rate that Larry just showed was up to 3.5. But the mortgage and credit sectors, the spread sectors, did well as investors were looking for more yield. High yield also did well, up about 4% as investors were pouring money into that area, again, searching for yield. Overall, it was a good quarter, and if you take a look at page 20 at the returns, on the far left, you'll see that the return for the quarter was 4.82%. Pretty good number for the quarter, given the volatility, and it was ahead of the benchmark. You also see for the fiscal year to date, this is as of March. Larry just showed you some updated numbers, but as of March, it was up 22%, and over the year, 15%. I also want to point out the 3-year number is now in positive territory because that does include the downturn in 08 and early 09, so we're now just shy of 4%. So I'm going to hit on the key points as Larry mentioned, since he went through March last month. So if you turn the page This is the asset allocation with the overweights, underweights. We went through this page last month, and in fact, in just a few moments, Larry's going to go through the April numbers, which are a little bit more up to date. So if you turn to page 26, I want to show you how police did versus other large funds. Defined here is over $10 billion in size. And if you look at the column on the left for the quarter, on the bottom 482 and the number in parentheses 10, that tells you that you ranked in the top decile, and the dot that you see in the graph on top, the bar chart, shows that you were near the top. So obviously, congratulations, those were very good numbers. Same thing for the 1 year number. If you slide over a little bit towards the middle, the 1506 return again was in the top decile. Going across for the longer periods, the returns were generally in the top quartile or the top half. Next page shows returns for years ending March. Again, year by year, depending on whether the market was up or down, shows different results. And now we'll actually turn to page 29 and turn it over to Seema for some comments on the equity program.
Thanks, Mark. Actually, if you go to page 31, this just lays out for you your domestic equity allocation across small, mid, and large cap and emerging managers. And I'll point you to two columns here. You can look at the index return column, and you can see some of the differences, and we've talked about this before when we spoke about our U.S. equity reallocation, taking money out of large cap and moving it into more mid and small cap. And you can see the different results in Q1 that kind of match up to the long-term trends that we spoke about. So the Russell 3000 index fund toward the bottom there was up a little over 6%. You can see the mid-cap S&P 400 is up over 9%. And then the small cap, the Russell 2000 index, is up about 8%. And then if you go another couple columns over to the right, you see the difference. And really across the board, our active managers have done quite well for us across small, mid, and large. So if you turn to page 38, we'll go through our international equity allocation. And you can see here, I just want to point out that the blue is the emerging markets, and you might remember we've increased our allocation there, although it didn't hit, particularly on the passive side, until mid-quarter, by the time we were able to transition the money, which actually helped us in the quarter. If you turn to page 39, just go quickly through the EFA markets, and the purple bar is our overall. So we did a little better than the passive index, which is up a little over 3% in the quarter. And if you turn to page 40, in emerging markets, in the quarter we're trailing a little bit behind the passive index, which was up a little over 2%. But again, we increased our allocation there. So, and with what happened in Japan during the quarter, it hit the emerging markets particularly hard. And so, as you also know, we're doing an emerging markets search, which is part of the new procurement process. And so we're hopeful to bring on some new additional strong performing managers, which will help that active piece of the pie. And that's it for us.
Seema, when do you think that'll be? The summer or the fall?
When we'll get it done? We're hoping to fund, so select and then fund sometime in the October timeframe.
So back to fixed income.
And back to Martin.
Turn to page 43. We have a pie chart that shows where the assets in fixed income are allocated. 30% of the fund was invested as of March 31st at $7.3 billion. Clearly, the largest allocation is shown in green, and that's your investment grade fixed income program, Core Plus 5. And breaking down Core Plus 5 further is shown on the next page, page 44. In the quarter, at the end of the quarter, the government sector was underweight and the mortgage sector was overweight. I'd like to draw your attention to the index or actual return columns, where you see that the returns for mortgages and credit were positive, but were slightly negative for the government treasury agency sector because of rates going up during that quarter. The good news is in the difference column, each of the three sectors outperformed their benchmarks. Putting it all together on the next page, we have the returns for the quarter, which was 0.70, while modest compared to the equity returns were pretty good numbers and were ahead of the benchmark. Fiscal year to date, also a modest number of 263, but well ahead of the benchmark. And for the 1 year, 690, 110 basis points ahead. And the returns for the longer time periods were in the mid 6% range with about 4 to 5% volatility. High yield, we've been talking about 4 months now that investors have been pouring money into high yield. And as you see, the results for the quarter were still very strong, 4.26% ahead of the benchmark for WB single B index. And for the fiscal year to date and 1 year period, returns were 14% also ahead of the benchmark. Returns were good as well for the longer time periods. Convertible bonds had good returns on an absolute basis, but were behind the benchmark. And the last page here is opportunistic fixed income on page 49, and we'll talk about it a little bit later on as well. Returns were very strong on an absolute basis and also versus the benchmark, but had higher volatility than the benchmark. And if Kathy is here.
I'm here. She's here.
Kathy's here. She's going to talk about ETIs.
Okay, good morning. The performance for your economically targeted investment portfolio is shown net of fees. It's a mortgage portfolio, and it very nicely outperformed both its custom benchmark and the Barclays aggregate for all periods. Your collateral benefits are shown in your board package on pages 56 to 61, and it shows the distribution of investments by manager and by borough. As there were minimal changes from last quarter, I will stop here unless you have any questions. Thank you.
Hi, moving on to real estate, I want to direct you to page 65 of the large report book, please. We're going to review the highlights of the real estate portfolio for the fourth quarter 2010. Very strong fourth quarter result of 10%, which kind of capped off a very good year of positive corrections. The police portfolio had steadily posted some positive quarterly returns, progressively increasing up to fourth quarter. Modestly, we started out at about 1.5% when we turned the corner first quarter this year, and now we're posting a 10% return just for this quarter. We've outperformed the benchmark by 530 basis points. The Odyssey Index for the fourth quarter 2010 was 4.7%. Your portfolio is approaching $500 million. The market value at year-end 2010 was $448 million. We had about $345 million of commitments that we had not funded yet. And altogether, that represents $793 million of investment activity for the police portfolio. The fourth quarter is a very critical period for money managers. Real estate is not unlike any other. So the managers are working very hard trying to turn their investments into favorable returns for investors. So if there's something that could potentially be sold by year end, they're working hard to do that for profitable realization. If there's something that they could buy at a great price, and if they could get it done year end, they will. If there's a big tenant they could snag, they will definitely try to do these. All of these events have an impact on valuation, and in terms of the fourth quarter, it's probably the best look at value for year end, because the core managers are evaluating their portfolios usually on a quarterly basis, no less than once a year, with an outside appraisal. And on the non-core side, some of the non-core managers value their own portfolios. However, it's subject to a look and a vetting by the third-party auditor once a year. So that's why fourth quarter is so critical in terms of valuation. If we kind of look at what happened in 2010 in terms of real estate activity, well, you had transaction volume that doubled over 2009. We talked a little bit before about where this activity took place. primarily in prime markets, primarily by investors seeking high quality, low risk type of investments. And so you find that transactions took place in New York, in San Francisco, in LA, in Chicago. Property types, apartments and office seem to be the preferred property types. However, as you read in the paper, there's a lot of activity in hotels. So in terms of where can you get that yield, probably could get that yield with the non-core managers who are looking for distressed sales, where they're working together either with the bank or together with the borrower to buy the debt at a discount and take over the property ultimately. There are managers who are willing to buy that property that may not be in the cities that I mentioned. Also, there are managers who are willing to undertake some leasing risk, and those particular spreads today are quite attractive. If we kind of look at the representation down at the bottom graphically about your returns, you'll see again that very strong first quarter. Also, kind of rolling into that really good 1-year return of 22.9 for the police portfolio. You see that's 760 basis points ahead of the index of 15.3. Underperformance in the 3-year period. That 3-year period kind of captures the credit crisis. So that's 2008, 2009, 2010. And, we're in the same spot as many institutional investors during that period. 5-year period, there's some underperformance again and out into the later years. However, I would say that with 26 managers and about 38 separate investments, and the fact that we increased our allocation just recently, the portfolio has grown, it's young, and I guess it's on its way to continue to deliver some results. In terms of a 2011 outlook, still positive, but certainly not the sharp positive correction that we saw in 2010. And if anyone has any other questions, I'll take them right now, but we'll talk a little bit further about specific things a little bit later.
Thanks, Ron. Barry?
So I'm going to give a brief overview on private equity. We are talking about the fourth quarter of last year, so as we are 5 to 6 months into 2011, a lot of these things you've heard of, so I'll try to be brief. To give a little overview of the market, so deal activity in 2010 continued to grow. There were almost 2,200 deals announced with an aggregate value of $225 billion. And just to put that into perspective, compared to 2009, it's an increase in numbers of almost 40%, but more importantly, it's an increase in value of almost 90%. The largest deal that was announced in 2010 was a $5.3 billion public-to-private transaction, which was Del Monte Foods. It was done by a consortia of general partners, KKR, Vestar, and Centerview, 3 partners that the pension system is not an investor with. If we look at what's happening today, private equity firms continue to capitalize on what we'll call the economic recession by growing companies not only through acquisitions of underperforming businesses, but adding in complementary new businesses. So that's just a brief overview of the market. If we go to page 74 in the, this we'll call it the phone book, talk a little bit about performance. So the performance for the quarter, performance for the year was quite strong. The system today is showing an inception-based return of 9.7%. If we look at that versus the 2 benchmarks, so the Russell plus 500, it's slightly underperformed the Russell plus 500, which is at 10.6%. The venture economics median is 0.3, so it's outperformed that significantly. What I would mention is that when we think about relative performance versus the venture economics benchmarks, it is important to note that as everyone knows, the median, it's the middle. The mean is the average. So when we think about it, the real benchmark to benchmark the portfolio against would be the top quartile. So later in the book, we mentioned the top quartile. The top quartile number we're showing is 8.3%. I think there's an argument to be made that that number is probably a band, somewhere between 8% and 12%. So we are on the margin, either modestly outperforming or underperforming, but we're moving in the right direction.
Is there a way to just add that to these reports?
So later in the
Yes,
executive
yes.
session, the answer is yes.
Thank you.
The one-year return is 17.4% for private equity. If we look on page 75, again, briefly, it's just going over the bands, corporate finance, which is buyout versus venture versus distress. The takeaway there is we're in line with the bands, in line with the allocations. If we touch briefly later in the presentation, what's interesting to note is that contributions and distributions, that's really a good benchmark to figure out how the portfolio is doing. If we look at the distribution pace, the pace continues to increase, although in the fourth quarter, contributions were ahead of distributions. To give a little preview for next year, it's changed now, so the system is getting more money back than they're putting into the asset class, so that's a real positive. Again, the overall portfolio, only one new investment made in the fourth quarter, which was a $40 million commitment. Strong takeaways here. One, valuations continue to increase. Distributions are going up. The portfolio is maturing. It's roughly 70% funded, so real dollars in the ground. And overall, everything is moving in the right direction. Last comment I would make in general as we think about this is one is the geographic diversification. Portfolio today is 90% U.S., 10% call it international, which is basically Western Europe. So again, the portfolio is moving into a direction of where it is a diversified or a balanced portfolio. Last comment I would make is that overall, we continue to believe the performance is strong, moving in the right direction. And with that, we'll leave it open if anybody has any questions.
The majority of the return that we're looking at here, that comes from the older funds predominantly?
Yes.
And the J curve?
Yeah, so what's
ones that are
happening?
producing, obviously, some money, getting some money back to us.
Correct. The seasoned assets are what we're returning capital, and it's a combination of things. One, on the unrealized side, so the fourth quarter is where the real valuation work is done. So the $100 million of appreciation, that's really a combination of mark to market. If we look at the distributions in the portfolio, those are assets that are traditionally 3 to 5 years old, 70% funded, so that's where you're starting to see capital come back. And in most cases, it's at or above the holding values.
So you would be able to say with some confidence that we were able, 3 to 5 years ago, we picked funds that are doing pretty well right now because of market conditions.
I would say if you look at the portfolio today, there continues to be funds that are performing well, that are making what we would say are strong distribution pace, and many of the assets will continue to grow.
So the answer is yes. Very good. Thank you.
Done, Barry?
Yes.
Okay. So let's go back. Let's get you from any question on the quarter? Okay, so let's go to April. Turn back to the monthly report, page 29. Monthly. So we're back. This is just a nice chart I want to start on. We're at $25 billion of assets, all-time high. Next page is 30. You can see the asset allocation where we are. We're basically over-allocated, particularly the U.S. stock market, under-allocated fixed income, which is a consistent theme, nothing new really in April. If you jump to page 32, in fact, better still, jump to page 33. Again, it's now June, but April, if you look down the far left-hand column, all the markets were on fire, basically, good fire. In April, recovering off of all the bouncing around because of the tsunami that was going on in Japan in March. So March was a bouncy month, recuperated in April. Basically, the markets were up, depending on which market. In the U.S., they were up about 2 or 3%. International, they were up 5+%. And the bond markets were also up. So if you go back to page 32, and you look at the far left-hand column, what you see is we made 2.67% in the month. everything is green, so we made money in virtually every asset class that we had. That took us to the third column, which is the fiscal year to date, so we're up about 25%. And as Martin mentioned, for 3 years, which include the collapse in 08, we're up about 3.5%. May is up a little, and June is going to be down, so it's not clear where we're going to end up the fiscal year. We'll just have to stay tuned. With that, we don't have very much to talk about, to be honest, on individual managers, because everyone performed well in April, so there's really not much to go through. Unless anyone has any questions on the April report, we'll go to the second item, or the third item on the agenda. Okay? So we had a great month in April. So that gets us over to the emerging manager review and recommendation, which we talked about last meeting. Seema?
Okay, thanks. So we went through a review and recommendation at the last meeting on the Emerging Manager Program, and we brought up wanting to get your vote on issuing the RFP. And so we're here today to get any comments or thoughts or questions that you might have. We did send out the scope. And so we've gotten comments back. We've incorporated those comments, and we're hoping to actually issue the RFP later this week. So we actually wanted to get your formal vote on being included in on that. The other systems are coming along.
So you just need a
Motion to- Need a motion.
to that. So make a motion that we release the RFP with the emerging managers portfolio.
Second.
PBA and the mayor's office. Okay.
Usually not a problem at this end.
No.
Okay?
Okay.
All in favor?
Aye. A rousing chorus of ayes.
Perfect.
Okay, thank you.
Thank you very
Don't
much.
don't hold back, people. Come on.
We decided, because we have so much to do in the second half of the session, we're going to postpone the asset allocation discussion until next month. That gets us to the opportunistic fixed income IPS. Martin?
Yes. So if you turn to page 109 in your agenda package, we have the opportunistic fixed income investment policy statement. And I'd like to draw your attention to a few items. First of all, on the bottom of page 1, we have the asset allocation, and we have language in there 0 to 5%. And secondly, I'd like to draw your attention on page 4 of the document, or 112 of the book, the benchmark of the program, which is now a 10% net benchmark. That will be the primary benchmark. That's after fees. The current benchmark of the program, as you saw in the quarterly reports, was the 4 plus 5 plus 200, so you see significant outperformance. We felt that the benchmark was a bit misaligned, especially looking at risk and returns. We also have a secondary benchmark, which is a global high-yield benchmark plus a premium. So we also have a handout here for you, which has additional language for the first page, the third paragraph, that more accurately describes what we're doing with the program. As I stall for time, as I look at the page, there it is. Just wait a moment for it to go around. Well, basically what the third paragraph, the red line third paragraph does, and again, that would replace the first page of the document.
You want to read it, Martin?
Sure. It says, from inception of the program, investments were limited to niche strategies structured as funds. The program will be expanded to develop core/satellite relationships to better exploit opportunistic strategies. This will be implemented through core separate account relationships and satellite relationships, either as separate accounts or fund investments. These investments will provide the opportunity to develop and invest in niche fixed income strategies that may arise over time. So what we're trying to put in here is the reality of how we're going about looking at opportunistic fixed income investments now, which include, as we've been talking for several months now, the core strategic mandates that are more flexible and nimble, to include that, and what we're referring to as the satellite relationships would be the funds, the niche funds that we've been investing in until now. But that's a change that we felt was a good point to put in here to reflect how the program's going. So effectively, that's the change that we have in here. Are there any questions?
So what we'd like to do is approve the opportunistic fixed income IPS and then move forward with selecting managers.
Martin, there's a number of terms, et cetera, in here. I was wondering if you could add a glossary to the IPS, just an explanation of terms.
What terms, what are you thinking of?
If you go through this, there's just a whole lot of going to, we described leverage, for example, but I know we included, did we put the main, did the leverage go into the main section here? That was in a separate addendum in teachers? Did the leverage explanations go into the main IPS here? That was in a glossary at the teachers?
At the teachers, the teachers, we had put in those two definitions of economic and financial knowledge.
Right, so we'll add, are those added here now, or we'll add them separately?
It's not here right now.
Oh, okay, yeah, so if you could add those, and if you go through, I can go back and look here. If you look at page 5, is post-reorg, restructured equities clear to people? I just think as you go through, and I can pull out instances, we've already talked to Martin about this, but just a very simple, here's what these terms mean, that's all. Not looking for anything more than what a typical glossary would contain.
All right. Easy enough.
We can
I'm hoping it's very
I
straightforward.
was going to say, unlike the hedge fund IPS, which had a lot of new, complicated things in it, this is pretty, most of the stuff is stuff we already invested, so we're not quite sure. We can work on a little leverage. We'll work with you to come up with some terms. Maybe you can tell us which ones you think should be offline, which ones you think should be defined, and we'll define them.
And what we'll do is we'll circulate it then to the board, so you see the page at the end of the glossary, but body of the document, those things.
Right. What we'd like to do is get it approved without the glossary.
Yeah, that doesn't,
right?
that's not a policy document.
Okay. So we need a motion to approve this IPS.
So moved?
Make a motion that we accept the investment policy statement in regards to the opportunistic fixed income portfolio. Second.
Second by Ganley, SBA. Any objections? All right, so moved, thank you.
That will be subject to a glossary or something that they're requesting to follow.
Just on terms that we haven't.
Could I make a request that we, this is going to be part of the IPS, so can we get a new updated emailed IPS to the trustees that will include this?
Yes.
So we can have it, for our records.
Yes.
Just,
Okay. So that ends the public session, unless anyone has any questions.
Okay, a motion to exit?
Motion to exit to leave public session and go into the executive session.
Motion by PBA,
Second.
second by the SBA. All objections, so moved.